When you watch Shark Tank, it feels like a show about products, ice creams, beauty brands, apps. But that is not what is happening inside the room. The sharks are not judging the products, they are judging the risk. They are asking one silent question again and again. If I put my money here, what are the chances I get 20x, 30x, or 100x back? Today, we are not breaking down any one single company. We will decode what investors want and are actually judging during a Shark Tank pitch. Chapter 1, the problem. The very first thing an investor evaluates is the problem, not the product, the problem. Why? Because weak problems create weak demand. When Skippy pitched, they did not say we sell ice pops. They highlighted hygiene issues in unorganized markets and the inefficiencies of the cold chain logistics. Investors immediately evaluate two things here. First, is the problem real and widespread? Second, is it a permanent problem or a temporary problem? Permanent problems are gold mines, and hygiene trust issues in food is a permanent problem. That means the opportunity is not a trend, but it is a gap. Chapter 2, the solution. After the problem is discussed, investors examine the solution, but they are not asking whether it tastes good. They are asking whether you actually solve those problems or not. Do you remember in our childhood we used to have one 2 rupees or 5 rupees Pepsi, but that was extremely unhealthy. The water that the unorganized companies used to put was very bad. So now Skippy didn't change a lot. They just improved the quality, put up a decent branding, and realized that people still have that nostalgia of eating that Pepsi, ice pops. But the main change they brought to the ecosystem was this. Skippy explained that they sell the ice pops in liquid form at room temperature and not directly the frozen ones. And what investors heard from this is cost elimination. Skippy reduced the cost by not freezing it and selling it, by directly selling it in water form, by removing cold chain logistics. They eliminated one of the biggest expenses in frozen food. That changes margin, scalability, capital intensity. Chapter 3, founder's background and why sharks obsess over it. The viewers often get confused when sharks dig deeply into a founder's background. So the sharks are basically evaluating execution capability of the founder, his vision, his team, his background, and not just enthusiasm. Chapter 4, numbers, where the emotions end. Once the storytelling is over, numbers crunching begin. Revenue, margins, cost, unit economics, burn rate, previous funding rounds. But why do these numbers matter so much? Because numbers remove fantasy. You cannot emotionally manipulate a financial statement. When Skippy revealed that their cost of goods were just 3 to 4 rupees per unit and the MRP was 20, sharks immediately calculated the gross margin. They thought about distribution margin, retailer's margin, and contribution margin. They visualized scalability. Investors are not impressed by revenue alone. They care about the unit economics as well, whether you make money on each unit sold or not. If selling one more unit increases profit predictably, that is scalable. If revenue increases but losses increase faster, that is dangerous. So the numbers only help the investors understand that whether growth will create value or destroy value. Chapter 5, business strategy. When Skippy explained their distribution model, sharks saw it can be scaled easily because the product does not require refrigeration. It can be placed in more stores and easily. That expands the total addressable market. And investors look at the TAM very carefully. If the market is massive, even decent execution can win. Chapter 6, evaluation. Many of you get confused over here. Now let me break it very simply for you. When the founder says 10 lakhs for 10% equity, what does it mean? It means that out of the total company, which is 100%, the founder is willing to give 10% of the company to the investor, and in return of that, he is asking for 10 lakh rupees. So the viewers just hear these numbers, but the investor hears confidence, dilution tolerance, and risk. Valuation is like price discovery. For beauty products is 5 to 6, for FMCG and other basic products is 3 to 4. As per the category, the revenue multiple changes, and investors value that company as per that. They compare the valuation with similar companies in their category. They assess their growth trajectory, whether the company is growing at a rapid pace or a slow pace. They also evaluate equity structure, whether the equity is split properly between all the co-founders or not. If founders undervalue value themselves a lot, it may signal lack of conviction to the investor. Investor derives valuation. Chapter 7. Why many pitches fail. Understanding why pitches fail teaches you more than understanding why they succeed. Most rejections happen because of unclear differentiation, weak unit economics, unrealistic valuation, lack of founder clarity, over dependence on marketing. Sometimes founders focus a lot on storytelling but cannot answer simple finance questions. Sometimes revenues look big but profit is negative per unit. Investors run away from these companies in which they spot these red flags. Chapter 8. How investors think about return. Here is something most viewers don't consider. Sharks are not investing for getting salary or dividend from the company. They are investing for exit. Exit comes when the company goes on to raise more and more funding rounds, or they get listed into the stock markets. They go for an IPO, or they sell themselves to some other competitor or a bigger company, or they get acquired by some other company. In these all exit cases, investors are hoping and willing to get 50 times, 100 times the return on their money. So whenever they evaluate a pitch, they mentally project future valuation of the company. Can this become a 100 crore brand? Can this become a 1,000 crore brand? Does this category allow that kind of scale? They did not invest in Skippy because they loved ice cream. They invested because they saw scalable brand creation. 3 lessons after decoding pitches. First, the storytelling and the founder vision matters a lot. He should be able to communicate on what he wants to build, why he wants to build. That creates belief and conviction in the investors. Number 2, numbers and operations are equally important. Even if you tell a good story, your storytelling will fail miserably. So both storytelling and numbers and execution should go hand in hand. Number 3, founder character is the topmost priority for the investor. They believe a founder when they see commitment, determination, hard work, execution capabilities, strategy, integrity, and so many other things. So even if you have a good storytelling, good numbers, but you lack integrity, the investor will see it as a very big red flag. So Shark Tank is not just entertainment. It is a commercial way to allocate capital. So if you train yourself to decode these pitches, you stop watching like a fan and start thinking like an investor. If this video taught you about Shark Tank pitches, hit the like button. Please hit the subscribe button. Comment down, do you like watching Shark Tank or not? So see you at the next video. Tata, bye bye, take care.